The typical millionaire in our surveys has a total annual realized income of less than 7% of their wealth. This means that less than 7% of their wealth is subject to some form of income tax. In our latest study of millionaires, the percentage was found to be 6.7%. Millionaires know that the more they spend, the more income they must realize. The more they realize, the more they must allocate for income taxes. So millionaires and those who will likely become affluent in the future adhere to an important rule. To build wealth, minimize your realized taxable income and maximize your unrealized income, wealth, capital appreciation without a cash flow. Income tax is the largest single annual expenditure for most households. It is tax on income, not on wealth, and not on the appreciation of wealth if this application is not realized, that is, if it does not generate cash flow. What is the message? Even many high income producing households are asset poor. One reason is that they maximize their realized incomes, often to support high consumption lifestyles. Such people might wish to ask themselves a simpler question: could I live on the equivalent of 6.7% of my wealth? It takes much discipline to become affluent. We have interviewed many people worth 2 or 3 million who have total realized annual household incomes of less than $80,000. How much does the typical American household realize in income each year? About $35,000 to $40,000, or nearly the equivalent of 90% of its net worth. The result is that the typical household in America pays the equivalent of more than 10% of its wealth in income taxes each year. How about millionaires whom we surveyed? On average, their annual income tax bill is an amount equal to only a bit over 2% of their wealth. Wow. That is one of the reasons they remain financially independent. Case study: Sharon and Barbara. Sharon is a high income producing healthcare specialist. She recently asked us, how is it that I make so much in terms of income but accumulate so little in terms of wealth? Last year, Sharon's household had a realized total annual income of approximately $220,000, which places her household in the top 1% of all households in America. Sharon's household has a net worth of approximately $370,000. While Sharon's income is higher than 99% of other households in America, her net worth is far below what it should be. Given her age, 51, and her income, $220,000, Sharon should, according to the wealth equation, expected net worth equals 1/10 times income, to be worth approximately 122,000. Why is Sharon's level of accumulated wealth far below the norm? Because her realized or taxable income is too high. Last year she paid $69,440 in federal tax on her $220,000 income. This is the equivalent of 18.8% of her total wealth. Yogi Berra might say, Sharon, you can't be wealthy. Your income is too high. We believe that the average person in Sharon's income age category pays the equivalent of only 6.2% of his wealth in annual federal tax, or $69,440 divided by 100 or 1,122,000. Thus, Sharon's tax equivalent, 18.8% of her wealth, is 3 times higher than the tax equivalent for the average person in her age income category. To view this another way, Sharon has an annual realized income that is equivalent to 59.5% of her total net worth of $370,000. How could anyone hope to become truly wealthy when the equivalent of nearly 60% of her wealth is subject to income tax each year? The average person in Sharon's income age category realizes the equivalent of only 19.6% of his net worth in annual income. Thus, only about $1 to $5 of his net worth is subject to income tax. What about people who have above average levels of wealth? How much of their equivalent net worth is being taxed? Barbara is a typical member of the PA category. Her realized annual income is approximately the same as Sharon's, $220,000. But Barbara's net worth is approximately $3,550,000. Therefore, the equivalent of only 6.2% of her wealth is subject to federal income tax. What percentage of Barbara's wealth is paid in federal income tax? Approximately 2%. In sharp contrast, Sharon paid the equivalent of 18.8% of her wealth in federal income tax, or more than 9 times the percentage of Barbara. The average American millionaire realizes significantly less than 10% of his net worth in annual income. In spite of having considerable wealth and substantial annual increases in wealth in unrealized form, a typical American millionaire may personally be cash poor. More than 20% of Barbara's annual realized income is invested in financial assets that tend to appreciate in value without generating realized income. Sharon, on the other hand, invests less than 3% of her realized income. Most of her financial assets are in liquid form. Sharon's economic situation is quite risky. She is the main breadwinner of her household, which has little investment income. If her employer eliminates her job, what then? There are not too many positions available today that pay $200,000 or more a year. Barbara, again in contrast to Sharon, has a business with more than 1,600 customers. That's 1,600 sources of income. This is much less risky than Sharon's position. Sharon could not survive for 6 months if she lost her source of income, but Barbara could easily survive for 20 or more years. Actually, she could retire at this point on her income from her financial assets alone. Barbara, the prodigious accumulator of wealth, is just one of more than 3.5 million millionaires in America today. More than 90% have net worth between 1 million and 10 million. How do these affluent people compare with the super affluent? Indications are that the higher one's net worth, the better one is at minimizing one's realized income. The fact that the super affluent got to that position by being masters at minimizing their realized income. Ross Perot is a perfect example of how the super affluent stay affluent and even enhance their levels of wealth year after year. Forbes recently estimated that Mr. Perot's net worth was $2.4 billion. The Citizens for Tax Justice, a tax reform group headquartered in Washington, D.C., estimated that Perot's annual realized income in 1995 was approximately $230 million. Thus, he realized the equivalent of 9.6% of his income, but only paid $19.5 million in tax, or 8.5% of his income. Compare this figure with the 31.6% of their income paid in tax by Barbara, Sharon, and many others in their income category. How does Mr. Perot end up paying such a small percentage of his income in tax? According to a recent newspaper report, Perot minimizes his tax bill by investing heavily in tax-free municipal tax-sheltered real estate and stocks with unrealized gains. Of particular interest, Perot's tax rate as a percentage of his income, that is 8.5%, is lower than the average American household. The average household in this country pays $4,248 in federal income tax each year, or the equivalent of 12.9% of their annual realized income of $32,823. Perot is super affluent in terms of accumulated wealth, but he has less than the common man's marginal tax liability. Even more interesting than the percentage of income paid in taxes is the percentage of wealth paid in taxes. The typical American household has a total net worth, including equity in their home, of $36,623. They pay the equivalent of 11.6% of their net worth in income tax. What about Mr. Perot, the billionaire? In 1 year, it is estimated he paid the equivalent of only 0.8% of his wealth in tax. In terms of income tax paid as a percentage of wealth, the typical household paid 14.5 times more. Most millionaires measure their success by their net worth, not their realized income. For the purposes of wealth building, income doesn't matter much. Once you're in a high income bracket, say $100,000 or $200,000 or more, it matters less how much more you make than what you do with what you already have. Working for the tax man. Assume for a few moments that you are Mr. Bob Stern, a scholar who works for the IRS. One morning, your manager, Mr. John Young, calls you into his office. He gives you an assignment to enhance his understanding of the relationship between income and wealth. Mr. Young: Bob, I keep reading reports about the growth of the millionaire population. Yes, I have a pile of articles and clippings on the same topic on my desk. Well, here's the problem. The number of wealthy people keeps rapidly increasing, but our income tax revenue for a lot of these people is not keeping pace. I read somewhere that the wealthiest 3.5% of the households in this country account for more than half of the personal wealth, but these same folks account for less than 30% of their income. I wish Congress would wake up. What this country needs is a tax on wealth. Even in biblical times, the rich had to pay 10% of their wealth each year in taxes. Now, that's what I call a ultimate tax reform. I know what you mean, but sooner or later we will get them. Remember, it's inevitable: death and taxes. The estate tax area is not your specialty, Bob. You are a little naive on this issue. You are thinking that we will eventually take a big bite out of the millionaires in this country by taxing their estates. The Grim Reaper is on our side. Not so fast, Bob. Just think of all the millionaires in this country. Most of them own some kind of business, and a whole bunch own stocks. What do these folks do with their money? They sit on it, or they plow it back into their business. They hold on to those stocks that keep appreciating. But what about the Grim Reaper? Look at it this way, Bob. We have often looked at real estate returns in the 1 million and above level. Last year, there were only about 25,000. But Bob, at the same time, there were 3.5 million millionaires alive and kicking. That means that 0.7% were picked up by the Reaper. This number should be twice as high. But you know what a lot of millionaires do? Before the Reaper shows up, they transform themselves. It's like magic. How do they do it? They can't just vanish. Do they move offshore before the Reaper shows up? Offshore is not a significant factor, but I would not be surprised if we found that half of our millionaires transform themselves into non-millionaires. BR. What do you mean by BR? It's an insider term. BR means before the Reaper or prior to death, as opposed to AR or after the Reaper. Look at this case study. Here's a woman, Lucy L., who had $7 million just a year before she died. She lived on her pension money, never in her life sold a share of stock out of her portfolio. Her wealth doubled in just 6 years between her 70th and 76th birthdays. But what did she get out of it? In terms of income tax, nearly zip. She essentially had no realized income from her portfolio. I hate unrealized income. You're right, it is a clever enemy, but the Reaper, he got her, right? Death and taxes. Wrong, Bob. She died last year. And do you know what her net worth was at the time the Reaper finally showed up? Less than $200,000. No estate taxes. Another former millionaire moves on without leaving a taxable estate. Some days I wish I were in another line of work. The enemy is winning. But where did all her money go? She gave it to her church, to colleges, and a dozen or more charitable organizations. She also gave $10,000 to every one of her children, grandchildren, nieces, and nephews. She's real country, loaded with relatives, like a lot of mountain people. And what did we finally end up with? You're not listening, Bob. We, the government, got Zippo. Can you believe it? Her own government. There's no justice. There's no justice in America. We need wealth tax. Well, she sounds like a pretty nice person to give so much to the church, colleges, and charity. Bob, shame on you. She and her ilk are the enemy. America needs their wealth to keep our government operating. We need her money to pay off the federal debt. We need to fund all our social programs. Perhaps she feels that her church, the colleges, and the charities also have needs. Bob, you are so naive. This woman is an amateur. What type of experience does she have dealing with her wealth, or doling out her wealth? We are her government. We're experts in redistributing wealth. We should decide where and how money is distributed. We are the pros. We have to start taxing wealth before all the millionaires transform themselves into non-millionaires. What about all those famous people we read about in the newspaper, the ones who have very high incomes? God bless them, Bob. They are our best customers. I love people who are big earners. Realized income is our salvation. I want you to study these types, but I also want you to find out how these other types can exist without realizing a lot of income. Some of them must live like monks. What's wrong with these people? Why don't they sell a few $1 million worth of stock and buy a mansion? Is that why you have all those pictures of America's highest paid celebrities on your walls of your den at home? You bet. I love those people. They've got a real bad case of the spends. And to spend, they have to have realized income. Look at it this way: when a ball player buys a $2 million boat, we become his partner. He will need to realize $4 million to pay $2 million for his boat. We are his partner. Ball players, are they good role models for our youth? Absolutely. They are high income spenders. They tell our youth to earn and spend. It's realized income that our youth needs to learn about. These spender types are true patriots. That's why I keep Webster's definition of patriot on my wall. Why don't you read it to me, Bob? Patriot, one who loves his country and zealously supports its authority and interests. Yes, Bob, I zealously support its authorities and interests. You know, Bob, the real patriots out there are people who earn big incomes, 100, 200,000, and a million or more and a year, and spend it all. Congress should mint a new medal for this type of patriotism, Bob. It would be called the Congressional Medal of Taxation and Consumption. And as long as these patriots keep training their kids to be medal winners, we are in good shape. Bob, do you think we should start sending out holiday greeting cards to all those companies that promote luxury cars, yachts, million-dollar homes, and expensive clothes and accessories? These people are really patriots in their own way. They encourage spending. They are keeping us in business. Well, Bob, it's getting late. You have your assignment. I want to know more about the medal winners, but I also want you to study the ways of those who don't spend their money. What evidence is there that the government knows the formula for becoming financially independent in America? Just read some of the articles its employees have written recently. Many well-trained economists and other scholars who work for our government frequently conduct studies about the rich, or as they refer to them, the top wealth holders. We are particularly interested in the articles published in the Internal Revenue Service's Statistics of Income, or quarterly report. It's a research scholar's paradise, providing mountains of statistics on income. But income is not the government's only focus. It also studies top wealth holders. We are envious. We have to do our own surveys of the affluent. That's our main source of understanding the how to get rich formula. C. Eugene Sturley is an associate director of the Office of Tax Analysts in the U.S. Department of the Treasury. He is also a scholar and talented researcher. He asks the same question we do. What is the relationship between realized income and wealth? What does he find? That people accumulate significant wealth by minimizing their realized taxable income and maximizing their unrealized non-taxable income. In the study that Mr. Sturley conducted, he compared the income tax returns that top wealth holders filed while they were alive with the estate returns their executives filed after the subjects passed away. He studies a national sample of estate tax returns. Then he matched each of these with their respective income tax returns from previous years. While this contrasting, Mr. Sturley wanted to study the correlation between realized income as documented in income tax returns and the actual net worth of each subject in the sample. Of special interest was the relationship between realized income generated from investments and their actual market value. Why would a scholar who works for our Treasury Department spend so much time conducting a study like this? We consider the staff of the IRS a clever bunch. They study their target market, and they lust for its wealth. They want to know how many affluent people generated so few dollars of realized income. Since owners of closely held businesses are especially adept at this strategy, Mr. Sturley selected for study those estates in which the value of the closely held businesses exceeded 65% of the estates. Here are some of the findings of Mr. Sturley's study. The income realized from the assets of closely held businesses was only 1.15% of the appraised value of the assets. Note that even the small percentage is likely to be biased in the upward direction, since there are estate tax advantages for heirs and executors who provide conservative appraisals. The total income realized from all assets and all salaries, wages, and income combined was only 3.66% of the value of all assets. What do these results tell you about the affluent? They suggest that a business owner who is worth, say, $2 million on average has an annual realized income of only $73,200, or 3.66% of the $2 million. Could you live on $73,200 today and still invest a minimum of 15% each year? No, it's not easy, but it's not easy being financially independent either. Financially independent. We once asked a high income, low net worth corporate manager, we refer to him as Mr. Rodney, a simple question. Why is it that you never participated in your corporation's tax advantage stock purchase plan? This employer offered him a matching stock purchase plan. Each year, the manager could purchase the equivalent of 6% of his income in shares of the corporation, which would reduce his realized taxable income. Also, the corporation would match his purchase of company stock up to a certain percentage of his income. Mr. Rodney reported that unfortunately he could not afford to participate. It seems that all his income went toward his $4,200 monthly mortgage payment, 2 leased vehicles, tuition bills, club dues, a vacation home that needed to be fixed up, and taxes. Ironically, Mr. Rodney wants eventually to become financially independent, but like most UAWs, Mr. Rodney is not realistic in this regard. He has sold his financial independence. What if he had taken full advantage of the tax advantaged benefits from the time he was first employed? Today he would be a millionaire. Instead, he is on the perpetual earn and consume treadmill. We have interviewed countless high-income, low-net-worth people. Sometimes it can be depressing, especially when the respondents are seniors. How would you like to be a 67-year-old cardiologist who has no pension plan, never had a pension plan? In spite of earning millions during his lifetime, his total net worth is less than $300,000. No wonder he started asking us the questions such as, will I ever be able to retire? Even more revealing are the interviews we hold with the widows of the UAWs. In many cases, the widows has been housewife throughout her long marriage. Often her mate, a high-income, low-net-worth type, was underinsured or had no life insurance at all. My husband always said not to worry about money. I'll always be here. He said, can you help me? What should I do? This is not a fun situation. How can well-educated, high-income people be so naive about money? Because being a well-educated, high-income earner does not automatically translate into financial independence. It takes planning and sacrificing. What if your goal is to become financially independent? Your plan should be to sacrifice high consumption today for financial independence tomorrow. Every dollar you earn to spend is first discounted by the tax man. Earning $100,000 may be required to purchase a $68,000 boat, for example. Millionaires tend to think this way. That's why only a minority own boats. Do you plan to live on a boat after you retire, or would you prefer to live on a $3 million pension plan? Can you do both? High status neighborhoods. If you read the last section about the IRS study of the affluent carefully, a question may have come to your mind. Are the results of the surveys we conducted different than those generated by income tax and estate tax returns? You will recall that on average, the millionaires in our last survey had a total realized income that was about 6.7% of their total net worth. The results from the income tax and estate tax, however, indicated that top wealth holders realized only 3.6% of their wealth. How can this difference be explained? And what does it mean? We employed a different sampling method than that used by the IRS in its study of income tax and estate tax returns. Our survey was based on sampling households that resided in high status neighborhoods, whereas the IRS sampled from all income tax and estate tax returns. Since about half of the millionaires in America today do not live in so-called high-status neighborhoods, we also surveyed affluent farmers, auctioneers, and other wealthy people who live in non-status neighborhoods. Why do millionaires from high-status areas realize significantly more than their wealth than those top wealth holders selected from a national sample of affluent descendants? Because the millionaires from high-status neighborhoods have to realize more income to live in these areas. What are the implications of our findings? It's easier to accumulate wealth if you don't live in a high-status neighborhood. But even those millionaires who do live in high-status areas realize only 6.7% of their wealth each year. Think of their non-affluent neighbors who, on average, must constantly realize more than 40% of their wealth just for the joy of living in a high status gulch. Perhaps you aren't as wealthy as you should be because you traded much of your current and future income just for the privilege of living in a home in a high status neighborhood. So even if you're earning $100,000 a year, you're not becoming wealthy. What you probably don't know is that your neighbor in the $300,000 house next to yours bought his house only after he became wealthy. You bought yours in anticipation of becoming wealthy. That day may never come. Each year, you are forced to maximize realized income just to make ends meet. You can't afford to invest any money. Essentially, you're at a stalemate. Your high domestic overhead requires that commitment of all your income. You will never become financially independent without purchasing investments that appreciate without income realization. So what's it going to be? Will you choose a lifetime of high taxes and high status living, or will you change your address? Allow us to help you in your decision making. Here is another one of our rules. If you're not yet wealthy but want to be someday, never purchase a home that requires a mortgage that is more than twice your household's total annual realized income. Living in less costly areas can enable you to spend less and invest more in your income. You will pay less for your home and correspondingly less for your property taxes. Your neighbors will be less likely to drive expensive motor vehicles. You will find it easier to keep up, even ahead of the Joneses, and still accumulate wealth. It's your choice. Perhaps you will make a better one than a young stockbroker, Bob, we recently advised. We gave him the same advice about the ideal ratio of home price to income. This 37-year-old broker had a realized income of $84,000. He wanted our advice about buying a $310,000 home. He planned to make a down payment of $60,000. He also planned to become wealthy. Carrying a $250,000 mortgage, we felt, would be an impediment to his goal. We suggested that he buy something less expensive, such as a $200,000 home with a $140,000 mortgage. This would be within the parameters of the rule. Bob rejected this advice. He did not want to live in a neighborhood full of truckers and construction workers. After all, he is a financial consultant and a college graduate. But what Bob does not realize is that many construction workers and their spouses have combined incomes of more than $84,000. Of course, his mortgage broker told him he qualified for a $250,000 mortgage, but that's like asking a fox to estimate the number of chickens in your coop.